Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 61 on May 11th, 2019. I'm your host, Eric, and in this week's show, we will cover the trades from last week on Pinterest, Starbucks, and Qualcomm, and we discuss 3 new trades on Beyond Meat, Coca-Cola, and Intel. Now, it's always great to hear from listeners, so if you have any questions about the trades presented here on the show, or even about your own positions, feel free to email me. You can reach me at eric@theweeklyoption.com. That's ERIC at theweeklyoption.com. I've also created a short video series to teach you all the basics of option trading that you'll need to know in order to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit our YouTube channel for the Weekly Option. Now, the equity markets fell about 2% this week, which is a change from the last several weeks where we've seen little to no week-over-week change. The Dow Jones Industrial Average lost 562 points, ending the week at 25,942 points. The S&P 500 index finished the week 64 points lower, closing on Friday at 2,881 points. Now, we'll dive into the topic of the week, and for this, I want to ask a question, and it's, what am I missing, right? This is the question you should always ask yourself anytime you see prices in the market that look a little too good to be true. So you never want to, there's a phrase called getting run over by a freight train or catching a falling knife. And in either scenario, you're basically going to get run over by the market. So the freight train tends to be used when the market's going higher. Catching a falling knife tends to be used when the market is going lower. And what ends up happening is you're diving into a market that is moving a specific direction or even priced a specific way for a reason. Sometimes there are temporary price bubbles or different extremes, and they may be caused from a number of things. It could be huge supply or demand on a specific strike. It could be a news event or an upcoming technical value like a support or resistance level coming. And it's easy to fall in love with price charts. Many of you guys use technical analysis just the same as I do. I use technical analysis in my as part of my research piece for trades each week. And when you're using technical analysis, it's easy at times to fall in love with the stock movement and miss the fundamental information that may be causing the actual movement. So to avoid getting suckered into a market that really is too good to be true, I turn to fundamental data. So what do I mean by that? I look for recent news. Is there anything that's happened to that company over the last week? Did the CEO make some comments? Is there some big earnings announcement, or maybe an analyst or some of the banks have upgraded or downgraded the stock? So I look for news about the stock itself. I look for things like dividends. Are they paying a dividend sometime soon? Is there anything about this company that has changed? So maybe there's a leadership change. Maybe they've added new facilities, or maybe they've had to close some facilities due to a change in the sales environment. So you want to find out as much news as you can about the company itself. Next, I look for news about the industry, news about competitors. Maybe this stock is moving in an extreme manner because of how it fits within its industry, either favorably or unfavorably. So you have to dig for information and see what you can find. If you don't find anything that supports the extreme price change or whatever you think might be too good to be true, then go ahead and put the trade on. Or maybe you do find news to support it and you might still decide to put the trade on. When I see trades that are priced in that sort of in what I would call the too good to be true range, I just adjust my size. I might decide to go ahead and put the trade on anyway. So I adjust the size of the trade for my risk level and to adjust or to account for the fact that something has happened in this stock or in the underlying options, and I'm not for sure certain, but the price is just pulling me in. So I don't bet the boat or bet the house when I'm looking at a price that just doesn't seem to make sense. So I tend to trade with a bit of caution, and that's what's allowed me to sustain positions and sustain this, just being able to trade for so many years. So let's take a look at the trades for last week. Let's go ahead and get into the review of the trades. We start off with the covered call on Pinterest, symbol PINS, Paul, Isaac, Nancy, Sam. Last week when we looked at this trade, the stock was trading for $28.36. And we looked at buying that stock and selling the May 29 call, collecting $1.65, which could yield a possible 8% return in 2 weeks. Just to start off, I have one correction from last week. I gave the wrong symbol. So if you looked at the symbol and realized that the one I gave you didn't work, that's because I left the S off. So it's PINS, PINS, rather than PIN, which is what I gave last week. So mea culpa, mea culpa. So that being said, Pinterest stock actually finished the week up a bit. $29.05 was the closing price on Friday, and it finished 69 cents higher over the week. The May 29 call that we sold is actually in the money now, just a little bit, and we are only 1 week away from May expiration. So as long as the stock closes above $29 on Friday, we will ultimately have made an 8% return on a trade in 2 weeks. Now that's taking into account the money that we earned from the stock. Of course, if you pick up the stock at $28.36, you'll actually be delivering that stock at the strike price of the option we sold, which is $29. So you have that, 64 cents, along with the $1.65 that we received when we sold that call option. So not bad for 2 weeks of trading. So we obviously have one more week to go. So I would leave this on and just follow it closely. Our second trade for the week is a credit spread on Starbucks, symbol SBUX, Sam, Brian, Uncle, X-Ray. The stock last week was trading for $78.05. We looked at selling the May 78, 77.5 put spread at 20 cents, which could lead to a possible maximum loss of 30 cents for the spread. Now, Starbucks stock rose 37 cents, ending the week at $37.42 per share. That out of the money put spread, which we sold, is still out of the money. The spread has only actually decreased 1 penny over the week. However, if stock stays where it is or goes higher for Starbucks, which is what the trend has been, we will get to keep that entire 20 cents we collected at the start of the trade. So 1 week left before we can pat ourselves on the back, but good. It's all going well so far, so keep an eye on that underlying stock. You definitely don't want to let a winner become a loser. And the final spread of the week, the final trade of last week, was a debit spread on Qualcomm, symbol QCOM, quantity Charles Oscar Mary. When we looked at this trade, the stock was trading for $89.29, and I looked at purchasing the May 88.89 call spread, paying 65 cents for that call spread, which could lead to a maximum gain of 35 cents or just shy of a 54% return in 2 weeks. Now, this one didn't work out so well for me. Qualcomm stock actually fell $3.45 this week, closing at $85.84 per share. The in-the-money call spread, which we purchased, is now only worth 17 cents, so that's a direct loss of 48 cents. Now, as you guys know, I hate losing money, so let's consider a few things we can do to either mitigate that loss or not lose money. Now, the challenge, of course, is that there's only 1 week left in this trade, and I really don't want to extend the risk into another month without truly believing in the direction of this trade. I like to keep all of my risk in the same month. That way, when May expiration happens on Friday, all of my May trades have expired, and now I'm free to move on to considering new trades in the upcoming months. So the stock chart still appears bullish to me. Prices moved lower to sort of fill the gap from the open price on April 23rd. The biggest question, of course, is whether or not prices will head back to $71 per share to fill the last major price gap that occurred on April 17th, just 1 week prior to that. Now, we only are really looking at one more week in this trade and the possibility of losing our entire 65 cents. I don't want to close the debit spread to maintain the 17 cents either. I could sell another call spread against this trade or consider selling an out of the money put spread, or do both. The reason I want to keep the original trade on is because it will appreciate quite a bit if the market moves a little bit higher on Monday. So by Tuesday, I will have a very clear, or much more clear picture of whether I want to close this trade out fully, and walk away, or stay in it. So since I'm staying in, I want to look at selling a call spread that is even further out of the money. Now, one caveat here: if I were to sell the at the money spread, the at the money call spread, I could not only lose money on the new spread that I'm selling, but I would also still lose money on that old spread if the market moving in the direction moving higher. So if I sell a further out of the money spread, then the only way I would need to deliver on the second call spread is if I made all of my money back on this original trade. So I can look at selling the May 89.90 call spread, which only has 1 week left. You would only collect 9 cents for that. And I typically wouldn't sell this spread, but of course we're selling it against owning the May 88.89 call spread. So that means it's essentially a bit of a hedge. And I would also look at selling the May 84.83 put spread, collecting 18 cents. So this pair of short spreads only yields 27 cents. You might want to sell two of each, which would give you a total of 54 cents that you would bring in, but be very aware of what you've just done, how you've changed the risk of the trade. I would actually lean against most of you doing that. Only do it if you truly understand options and fully understand what you're doing to your position, because with 1 week left in this trade, I don't want you to create I don't want you to multiply your losses just to try to cover your loss. So barring a massive move higher this week, this trade will likely end in a little bit of a loss. I'm just trying to limit the overall size of that loss. So I'm also trying to avoid digging a deeper hole. Some of you might want to keep it simple and just sell the original trade and walk away. That's not a bad option either. I personally will wait, Monday or Tuesday, and just I want more information. We'll see how this trade ends up, or how this underlying stock plays out this week. So that's it for last week's trades. This upcoming week, of course, on Friday is May expiration. So all of your May trades will expire. If you have any that are on, they will either be in the money and worth their intrinsic value, or out of the money and worth zero. And the new trades for this week's show will all be in June expiration. You guys have seen me make 1 week trades in the past. Sometimes there are some great opportunities, or things that appear to be great opportunities even in that last week of trading. I just want to avoid that and just go ahead and focus on June. So June expiration cycle is going to be a bit long. It's actually 6 weeks from now, or 5 weeks from May expiration. So just know that with these June trades, there's an extra week in there of risk being priced in. So let's start off with the covered call. We're going to start off with the covered call on Beyond Meat, symbol BYND, Brian Yellow Nancy David. Stock ended the week at $66.22 per share. I'm looking at buying that stock and selling the June 67.5 call, collecting $5.90, and that could yield a 10.84% return in 6 weeks. Now you enter this trade by buying Beyond Meat stock at $66.22, and of course selling that June 67.5 call at $5.90. This trade makes the most money if stock prices finish above $67.50 per share. Now, this stock actually IPO'd this week. It had its initial public offering, and it's come off a little bit, but I like the stock. I also like the $5.90 that you're picking up for selling this. So because you're receiving so much premium in this call option, the $5.90, it actually moves your break-even point down to $60.32 in the stock. So I like having that large cushion, and I also like putting this trade on. So that is the covered call for the week. Next, we're going to look at a credit spread on Coca-Cola, symbol KO, Kevin Oscar. Stock ended the week at $48.19, and I'm looking at selling the June 47 put spread at 35 cents, which creates a maximum loss on that spread of 65 cents. Now, you enter this trade by selling the June 48 put at 91 cents and buying the June 47 put at 56 cents. This is a credit spread because we are selling the spread. This trade makes the most money if stock prices end above $48 per share. And our final trade on the week is going to be a debit spread on Intel, symbol INTC, Isaac Nancy Thomas Charles. The stock ended the week at $46.20, and I'm looking at buying the June 47 put spread, paying 66 cents, which creates a maximum gain scenario of 34 cents or 51.5% return. Now you enter this trade by buying the June 48 put for $2.66 and selling the June 47 put at $2. This is a debit spread because we are buying the spread, and this trade makes the most money if stock prices stay below $47 per share. And the interesting thing about this, if you pull up a stock or pull up the price chart on Intel, you'll see that this stock really fell hard this past week. And the CEO also made some comments about some upcoming changes with regards to the supply of their new chip. And several banks have downgraded this stock. So do I think Intel will stay lower forever? No, but I do think this is a trade that could be profitable here over the next few weeks. So that's it. Thank you so much for listening. Of course, if you have any questions, feel free to email me. My email address is eric@theweeklyoption.com. Have a phenomenal week. Happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.